SpaceX stock jumped 20% on IPO day. Then it lost almost a third of its value over the following months. Nobody tells you that part. Anthropic and OpenAI have both filed confidential paperwork for IPOs. Another wave of mega-IPOs is coming in 2026, and when it lands, everyone is going to want a piece of day one. Before you do, you should understand what actually happens mechanically on IPO day, not the headline version, the real one. We're going to use SpaceX's actual post-IPO price action as the case study because the numbers are public and the pattern is exactly what tends to repeat. Let's start with the basic thing most people get wrong. The IPO price is not a market price. It's a number set by underwriters, the banks running the offering, based on investor demand during the roadshow. It's a negotiated starting point, not a verdict from the market. The market only starts pricing the stock once trading actually opens. And that first day is one of the most volatile, least reliable windows in a stock's entire life. Here's why. On day one, the float, the number of shares actually available to trade, is small. Most of the company's shares are still locked up, held by employees, founders, and early investors who aren't allowed to sell yet. With a small float and enormous demand, prices swing hard in both directions. That's not the market deciding what the company is worth. That's just supply and demand doing exactly what it does when supply is artificially thin. Take SpaceX. On IPO day, the stock popped 20%. Headlines called it a triumphant debut. Retail investors piled in, chasing the move. But over the following months, without any single dramatic event, the stock drifted down from around $225 to around $153. That's not a scandal. That's not the company failing. That's price discovery. It's the market spending weeks or months figuring out what the company is actually worth once the initial excitement, the limited float, and the media hype settle out. Now here's the mechanism that makes this even more predictable: lockup periods. When a company goes public, insiders, employees, founders, venture investors typically can't sell their shares for 90 to 180 days after the IPO. That's the lockup period. It exists so insiders can't dump shares on day one and leave new retail investors holding the bag. But when that lockup expires, a wave of new sellers hits the market all at once. Insiders who've been sitting on paper wealth for months finally get to convert some of it to cash. That often creates a second wave of price pressure, sometimes months after everyone's already forgotten about the IPO. So you end up with two predictable pressure points in almost every IPO: the initial volatility from a thin float on day one, and the lockup expiration pressure months later. Neither one is really about whether the company is good or bad. They're structural. They happen almost regardless of the business itself. This is why day one price action tells you almost nothing about a company's long-term trajectory. A stock can pop 20% and still be down a year later. A stock can open flat or even drop on day one and go on to perform completely differently over time. The first day is noise. It's mechanics, not a verdict. When Anthropic, OpenAI, or whichever company IPOs next actually opens for trading, you're going to see the exact same pattern: a loud headline number, a lot of noise, and very little signal about what happens 6 months out. Here's the part worth sitting with. When a stock is all over the news, moving 20% in a single day, that's exactly the moment FOMO is loudest. Everyone's talking about it. Everyone feels like they're missing something if they're not in. So ask yourself, when you've made a fast decision on a hot stock, were you actually reasoning it through? Or were you reacting to a headline, a group chat, a feed full of people saying they're already in? The IPOs that actually hurt people aren't usually the ones that eventually dropped. It's the ones bought at the loudest possible moment, the peak of the noise, not the peak of the information. That's not a flaw specific to IPOs. It's a pattern that shows up anytime there's a fast-moving, high-attention event in the market. The event changes. The pattern in you doesn't. You don't need to predict the next IPO, and honestly, nobody reliably can. What's actually useful is knowing your own pattern, recognizing the moment you're about to act on noise instead of on reasoning. That's what Whisper is built to help with. It's a trading journal that shows you the why behind your own past moves, so the next time a headline hits, you already know how you tend to react.